It's a general agreement that quarter two may not be as rosy as the first, and this could result in Tesla's stock price taking a hit. Recently, Tesla's shares fell more than 12%, while the tech-savvy NASDAQ composite fell about 4%. Apple, Amazon, Google, and Facebook parent Meta were among the mega-cap tech stocks that fell more than 3%. Rivian and Lucid, two electric vehicle manufacturers, also fell 9.5% and 8.5% respectively. So what's in store for Tesla and its investors in quarter two? Let's dive in. In what was a truly extraordinary quarter, Tesla delivered multiple beats. As demand continues to surpass supply, it has shown its manufacturing efficiency and market supremacy. Revenue was $18.8 billion, increasing 80.5% year over year versus the $18 billion in estimates on Wall Street. It also generated adjusted earnings per share of $3.22, greatly beating consensus projections of $2.26. While some are wary about Tesla's future performance, the market remains hopeful though, considering the company's relative outperformance versus its auto counterparts. As a result, we believe Tesla's first quarter performance has already been factored in. Even after excluding regulatory credits, the magnitude of Tesla's earnings beats was astounding. Furthermore, the company's ability to reduce sales costs while rising prices highlighted its exceptional manufacturing efficiencies and pricing leadership. Elon Musk, the CEO of Tesla, has stated that the company is experiencing supply issues, but has no immediate concerns about demand issues. As a result, that should allay some investors' fears about a more competitive environment. We also believe the company is well positioned to flourish in a fast increasing electric vehicle sector that will thrive despite higher inflation. Nonetheless, we believe that investors' attention should be drawn to the Q2 production recovery programs. On the other hand, Musk is optimistic about the restart of Giga Shanghai. He also maintained Tesla's 50% production growth rate, even speculating that 60% growth by the end of 2022 would be achievable. Automakers, including Tesla, are grappling with growing raw material costs for batteries, as well as a semiconductor chip shortfall exacerbated by Shanghai's COVID limitations. While Tesla's automotive revenue increased 87% year over year to $16.86 billion in the first quarter of 2022, the firm missed nearly a month of build volume in Shanghai due to COVID shutdowns. The company claimed in its earnings release on April 20th, in the first quarter of 2022, Tesla made $4.65 billion in China. Tesla's revenue presently comes from China at a rate of 24.8%. Tesla has also begun shipping vehicles from China to markets in Asia and Europe. The company has constructed a new manufacturing plant in Austin, Texas, as well as another in Brandenburg, Germany. Regarding the company's results call, CFO Zach Kirkhorn stated, "Our delivery times for most autos are rather long. Those delivered in the first quarter had a price that was set in previous quarters and was lower than what was being ordered now." He subsequently added, "Production is resuming at a restricted level, and we're aiming to get back to full production as soon as possible." Tesla also has no plans to hike prices anytime soon. "The present costs are for a vehicle delivered in the future, like 6 to 12 months from now," Musk stated on the same call. Analysts were particularly concerned about the impact of the recent supply chain issues and rising raw material costs on Tesla's bottom line. On the other hand, Tesla's adjusted solid EPS performance assured investors of the company's exceptional capacity of generating profits in a difficult macro environment. The company disclosed regulatory credits of $679 million, much exceeding the $312 million average estimate. Even after removing the credits, Tesla still generated an adjusted EPS of $2.90, which is much more than the street's expectations of $2.26. For the first time, automobile gross margins exceeded 30%. Tesla also stated that it had begun a series of price increases in anticipation of growing costs in the future. While these problems may not have been fully reflected in its P&L, we anticipate that hitting the 30% barrier in Q2 will be difficult. According to recent commentary, China's leading LFP battery provider CATL is suffering substantial raw material cost issues as it prepares to release its Q1 card. These difficulties were projected to significantly impact the company's profitability in the first quarter. In addition, CATL has proposed raising pricing with its clients as their contracts come up for renewal. As a result, sources in China claim that CATL will likely boost its pricing significantly starting in Q2. According to Shanghai Securities News, one thing is certain: The rise in upstream battery raw material prices has put pressure on mainstream battery manufacturers like CATL. The spike in raw material prices will be passed on to the electric car manufacturers in the future, putting customers on the hook for yet another round of new energy vehicle price hikes. Customers will see a price hike from CATL in the second quarter. However, Tesla is still in talks with CATL, and the current topic of conversation is whether to hike prices by 10% or 15%. As indicated by Apple and Microsoft, there has been a movement in market sentiment away from high-tech equities. But on the other hand, there are concerns about China's continuous COVID-related shutdowns and supply chain issues. In its earnings conference, Tesla also hinted at contract renewals. Zachary Kirkhorn, CFO, emphasized that raw materials account for 10% to 15% of their total cost structure, but it also has no immediate or direct impact on the company. According to Kirkhorn, Tesla has arrangements with vendors in some circumstances. However, once those contracts expire, we must renegotiate them to allow for a lag. He said, "Our contracts do, in some situations, immediately reflect changes in commodity or raw material prices. However, due to the contract, the timing in which Tesla pays for that has a lag as well." In Q3 and Q4, he believes production will be significantly higher. As a result, it appears that they might be able to build more than 1.5 million cars this year. It takes about 9 to 12 months from the commencement of production to the point where a factory is complete and producing a modest number of units to the point where it's producing high-quality automobiles in volume. However, it might take them about over a year to reach the 5,000 per week level from the start of production. There's also the Twitter situation. After Elon acquired Twitter, Tesla's stock price took a slight hit. The drop came just one day after Twitter's board of directors authorized Musk's $44 billion acquisition of the firm, implying that some of the drops are due to investor concerns about the deal. Musk has a total debt commitment of $25.5 billion, including $12.5 billion in loans secured against his Tesla equity. A total of $21 billion in equity is included in the deal. Despite being the world's richest man, Musk's fortune is heavily invested in Tesla stock, which means he'd have to borrow against his assets to pay the transaction. Tesla investors may also be concerned about the potential distractions that owning a platform like Twitter could bring. Musk has looked to desire a lot of say in how the company operates, which could put him under time pressure. Musk will be in charge of Tesla, Twitter, and SpaceX if the acquisition goes through. He also owns The Boring Company and Neuralink, two smaller businesses. Musk's optimism, we feel, is also noteworthy. The shutdown of Giga Shanghai is expected to have cost Tesla roughly 50,000 units of manufacturing. The company, on the other hand, is dedicated to Model Y construction and production simplification. The Model Y structure has been simplified as a result of the new Giga Texas production method. In comparison to the present Model 3 construction, Tesla has removed over 1,600 welds and dramatically reduced the structure of Model Y. In the earnings call, Tesla clarified the improvements. They also emphasized that because they've learned a lot, they should be able to ramp up manufacturing faster in Texas and Berlin compared to Shanghai. Is it nevertheless possible for Tesla to have a great 2022? Tesla, for one, believes so. This is evidenced by various aspects of management's optimism from its major learnings from Shanghai's ramp during the earnings call. It also believes that considerable improvements in its cutting-edge manufacturing process will be critical. We believe that Tesla has shown its auto and tech counterparts how to perform in a severely difficult macro context. But rather than making excuses, the Tesla crew has continued to thrive in various situations, no matter how difficult they appear to be. However, a combination of all the factors we've mentioned in this video may cause a shift in market sentiment and hurt Tesla's stock price. Do you think Tesla will have a great second quarter? Comment down below.